I first want to thank the MCC for hosting this, as well as our panelists for taking time out of their day to come here and talk with everybody. As Maureen said, I'm Nick Fisfus. I'm the president of the Graduate Finance Association for the class of 2025. And I just want to take a moment here to introduce our wonderful group of panelists. And that figures the clicker just stopped working.
I used it mine because I was getting that. Find out how. Even the advance arrow is not working. Hold on a sec.
There we go. So I want to start with Lee. He is a managing director at the Dietrich Foundation, where he focuses on manager selection and portfolio monitoring. Before that, he was with BNY Mellon, as well as an officer in the United States Army. Thank you for your service, Lee. He has his mathematics degree from Vanderbilt and his MBA from the Cat School at the University of Pittsburgh. Our second panelist.
I got you.
Is Amanda Upton, who's a managing director at the Hillman Company. And Amanda, I just want to say, I was looking over the history of the Hillman Company. It was extremely interesting. So I'm hoping you spent a little time today talking about that. So she previously worked in private equity in North Carolina. She also has her undergraduate's degree from UNC and her MBA from Harvard Business School. And our final panelist for today is Chris, who I think some people in this room already know because he is a Tepper class of 2023 graduate. So Chris, welcome back. He previously actually worked at Carnegie Mellon's endowment as well as in asset-backed finance at PNC Bank, which I also worked at, Chris. I think I mentioned that. And he's currently working for the University of Pittsburgh's endowment fund. Can hit it one more time.
Yep.
So I want to start out here with just a general question for all three of you, which is, what does it mean to you guys to invest in public good?
So Bill Dietrich sold his company in 1996 and took home $175 million and felt like that was a societal responsibility. He took a lot of weight in Andrew Carnegie's famous essay called The Gospel of Wealth, where Carnegie said, the man who dies rich dies disgraced. And so Bill, only in his mid-50s, wanted to give all of it away. And so the rest of his life investing so that that would be a larger pot of resources for his philanthropic mission down the road. So what that means today, and the reason I work for a nonprofit, but in a very commercial perspective, is that we are trying to grow this pool of assets as aggressively and as prudently as we can, so that we're writing larger and larger checks every year to Bill's predefined support organizations. So at the Dietrich Foundation, the largest beneficiary is Carnegie Mellon University, so it's the Dietrich College of Humanities. The second is the University of Pittsburgh, and it's the Dietrich College of Arts and Sciences across the street. And so those two make up a little over 3/4 of our annual gift, and it's really to benefit research, scholarships, recruit world-class professors, and then other things that the presidents of the universities think are strategic. And so for me, if you walked into our office, I don't think that we look like a nonprofit when I think of words like social good. We're more kind of an operating business trying to generate profit to then fund Bill's philanthropic vision. So we just, instead of working on behalf of a family, local family, we're working on behalf of the university, trying to make sure that we can give them larger and larger.
Yeah, so, given my background at CMU's investment office and now at Pitt's investment office, I think there's a lot of similarities between, university endowment and kind of a Dietrich Foundation that supports essentially each of these universities' endowments. And I think the question goes back to, what is the mission of an endowment? And it's not necessarily to generate public good, directly. You're not We're not a donor advising fund. We're not making grants directly. We're really in existence to support the mission of the university, which has its own mission for the public good, if you can say that, more on the education aspects, programs, and grant making and all that. So there's a lot of overlap between a university endowment and what Lee just said.
Sure. So I think in our industry of investment management in general, I think of kind of two categories of public good. And one is just enabling a more stable quality of life or a more stable program for a very long period of time. And that can look like what you guys do at a university endowment, keeping that university's programs, stable for a long period, especially through periods like COVID, for example, on that endowment more heavily. During periods like that, you can reinvest in it, but you don't much during other periods. Same goes for many of the public pensions out there. Some that I admire and that are very well run are like some of the Canadian pensions, very solvent, first of all, and have some really thoughtful people planning for enabling a stable quality of life for Canadians for 100 years plus. Same goes for some of the sovereign wealth funds out of, for example, Scandinavia, actually Australia and broader Europe. They're all very well run, very, very well planned for extremely long periods of time, and I think are an incredible asset for those societies. And then, so that's one category of what I've seen as public good in investment management. And then the other category is what has, evolved in parlance. Recently, you hear people talk about ESG. I guess we're moving away from that term now, but generally, it's investing in what comes down to good people and good management teams in industries that are actually creating real value for the world, and making sure that we're all investing in that and not something lesser than that. And so there are varying degrees of doing that on a spectrum, from just basic risk management on through to full impact investing, which has a double or triple bottom line. But that's kind of generally the other category.
Excellent teamwork going on up here, passing the mic back and forth. And I just want to say, for anybody who doesn't find the MBA to be, difficult enough, Amanda was just hitting on what are several CFA topics related to endowments and funds that, you really want to challenge yourself, you could always go for that. But I want to come back, Lee, to something you were talking about with Bill Dietrich, who, as someone who's from Pittsburgh, I mean, that name means a lot around here. And can you just expand a little bit on, why you wanted to go to the Dietrich Fund and why you love your job and why you enjoy what you do?
So I want to tell you that it's all about the public good. It came down to the what I would be doing on a daily basis, right? So when I was at corporate development, BNY Mellon, this was so if you've ever looked at a corporate development job, that's the internal M&A at the company. So you always have to hire an advisor like JP Morgan for smaller transactions are done internally. So for 5 years, I was just, the sort of investment banking light of spreadsheets, PowerPoint presentations for deals that weren't going anywhere. But I knew my boss now at the time, and he was kind of explaining to me what they were doing and what Bill Dietrich's vision was. And so the thought of investing in private equity, which we're not really transactions on a daily basis at the foundation, we're investing in private equity funds primarily, which, then are managers that go find companies. But to be able to, on a daily basis, look at all the different ways to make money all around the world, right? So on a Tuesday, I could start my day with a Zoom of someone in Singapore who has a venture capital fund focused on Southeast Asia, could meet someone in our office that's in from Chicago doing lower middle market buyouts in the Midwest, go out to lunch with one of our China VC managers that happen to be in town. So you get a sense of like every day we're just being peppered with really bright people who have what they think is a novel way to invest and produce returns. And then, oh, by the way, it's for these great causes like that are in our backyard. And the really fulfilling part is when we occasionally get the letter from a student that says, "Hi, I don't know who to address this to, but I got a scholarship from the Dietrich Foundation or through the endowment funds that were flagged Dietrich, and you allowed me to be a first generation college graduate. My parents never could have afforded for me to go to Pitt, and this has changed our life, and I just felt the need to tell somebody that." Or we see, as you described during COVID, some of the cultural organizations that the Dietrich Foundation supports really see their attendance and maybe their staff decline, but because of the strength of their endowments at the different cultural institutions that we support and we're writing checks to, they were able to weather through that. So the fact that intellectually get to do what I think is a very fun job with people that I really enjoy working with, I would sell tires with them. And the fact that it benefits stuff that my kids get to go to Carnegie museums and see things that I know we were part of financing. That's the fun part about it.
It's awesome. So I want to move forward here a little bit because when we think about sort of, you talked about some of the firms that you invest in. Chris, I don't think we've talked that much yet about what you guys do. And then I mentioned the Hillman Company has a really interesting history and a lot of really interesting things that they do. Can you guys talk a little bit about what each of your areas investment philosophy is and the things that you focus on?
Well, we'll let Amanda go and then kind of tell me.
So do you want me to get into the Hillman history or do you want me to just focus on the philosophy right now? Okay, so the Hillman history is it either dates back to kind of the mid 1800s or the World War time period in Pittsburgh, depending on where you want to go. And for those of you that are from Pittsburgh, you might be aware that this is a boom and bust town economically, historically. And so a tremendous amount of wealth was generated around the World War time period. Like if you look at Alcoa's EBITDA, inflation adjusted from that time period, current recent earnings don't come anywhere close to what was made during World War II. So as part of that general history, the Hillman family had a number of operating businesses around steel, things like transportation, some coal and chemicals broking, that did really well during that time period. And Henry Hillman, who's either Gen 1 or Gen 2, again, depending on how far you want to go back, had the prescience as a geology major to kind of look at some of the coal and chemicals broking industries and the steel industry in general to say, this feels like it's not going to last. And so started on a path to really shut all that down and move into more modern industries like pharmaceuticals, which tied in back then to the chemical side of the business. Calgon Chemicals actually sold to what became Merck. And Henry had a board seat on Merck for a while, and that sort of got us into ultimately biotech. And so that's part of the history. There were some other assets too, like real estate development in the 60s, an early founding stake in what's been rolled up in the PNC Bank starting in the 50s. The largest natural gas pipeline east of the Mississippi in the 1940s. And I'm sure I'm missing a long list. But those are some of the assets. All the operating stuff's been sold off a long time ago. And we've started the foundation. I'm not exactly sure when the foundation was started, to be honest, but a couple of months before I joined a decade ago. And Henry really started this plan for, on the family side, to build out the trusts to be multi-generational, not just for his kids, but for future generations. He wasn't even thinking about of Hillman family members. And I would say the trusts there are a lot of family offices out there. I've seen a number of them, enough to know that many of them are not as well structured through the generations as this one is on the trust side. And then on the foundation side, the same goes. There's a lot to get into in terms of thinking through the generations of family members that might want to be involved with philanthropy and how do you structure the foundation to think through that long-term planning. And I think it's been as well thought through as anything I've seen. So that's some of the history. Fast forward to today on the grant giving side at the foundation. It's increased a lot the last few years since Henry's death, and most of his assets moving over to the foundation. So I think we're at 80 to 90 million of annual grant giving activity, give or take. And that goes into things like Carnegie Mellon and other educational institutions, a lot of healthcare initiatives around UPMC and some things on the front lines, like with the homeless population. There's a big initiative in Better Food for More People, and some smart cities initiatives addressing things like traffic, often in partnership with Carnegie Mellon again. And then on the investment side, what we do is purely financially driven, and on that ESG spectrum that we talked about, we're on the risk management end of it. So we don't do impact investing, we're purely for profit as a mandate, but I would say that there are some things that we avoid, and reputational risk is how I think about it on the day-to-day, and it's just paramount, given that we do operate essentially getting into marriages with people with how long-term of an underwriting perspective we have. I don't want to marry someone who I have questions about reputationally or judgment-wise or otherwise, and so I think that's how most of us think about that kind of philosophy. And in terms of other investment philosophies, given that we have a long duration, we tend to be pretty risk on, pretty equity oriented. We don't do too much in credit because it just doesn't have enough sort of juice in the return. And it's very short, it's a much shorter duration asset that we don't need to do. And then we're very private equity oriented as well, because we do have that long duration that we can benefit from. So we look for the higher return within private equity.
So just to follow up, this might be good for people who don't necessarily understand the longer duration cycle. Why isn't it that
Higher returns over time, generally. Yeah, I mean, it's not guaranteed, but you do see that play out in the stats.
you guys are able to do that because there isn't this, consistent pressure on, short-term returns that people are looking for, right?
I mean, and we could probably get into a debate about why do private assets outperform liquid assets? And I'm not sure that there's actually a really clear answer. But the theories behind it are that it's a harder to access market. Not as many capital providers can get into it. A retail investor, you guys probably can't get into the market at all. You have to, by regulation in the US, be a qualified purchaser for most of these, which I think means you need 5 million of net worth, or you need a liquidity requirement. And then maybe you can be an accredited investor. That's a lower level, but really you need to be a QP. And even if you meet the regulatory requirement, you probably can't get access unless you can write checks of kind of $5 million plus per fund. So I think that the access question is a big part of it.
Okay.
And then the patience and willingness, ability to hold for the long term is another part of it, which all rolls back up to you need a big pool of capital to be able to do it. Yep. Not everybody has that.
Thank you.
Yeah, so I think in terms of, college endowments overall, I heard this one great saying where it's, we have one client, they never pay taxes and they never die. And so you always try to find, investment horizons, investment strategies that kind of play well to that. So I think that kind of is the overarching theme of, why so many universities have diversified into alternative investments, illiquid private vehicles that have a minimum 10-year fund life versus, investing mostly in index funds or public equity hedge funds that have a shorter fund vehicle life, just because you can get out of them faster than you can get out of a private equity vehicle. And just echoing on the credit side, I think a lot of endowments are probably more equity oriented. And I think the case for credit can be made, especially given now where you have, Fed funds rate at 5.25 or whatever it is, and a spread above that, you're already hitting your, endowment return targets, which is roughly 5% spend plus CPI, but what we define as CPI is higher education pricing index, which is a little bit above CPI, so call it 7-8%. And so you can essentially find that in the credit markets. But what doesn't get talked about as much is, I worked at PNC, and the CEO one time on an earnings call said, credit is the only market where you can hide your cost of goods sold. And so you never know when that drawdown is. You kind of plan for that with, loan loss provisions on the banking side, but on the private credit side, they don't really have a mechanism for that. So I think that doesn't get talked about as much. I'm sure they always have a slide on their pitch book that says, hey, we could go into asset management workouts, we could do bankruptcy, Chapter 11 workouts, and that's all good and done. But some of the private credit or credit investors now, they haven't seen a major crunch in, a decade plus. So that's just my take on it.
Yeah, I think what you're consistently hearing across us is that organizations that have, like varying views, or I guess varying levels of time horizon, right? But mostly we think of ourselves as perpetual pools of capital, right? There's not going to be an ultimate, and trust might be a little bit different, of course, but there's not going to be an ultimate liquidation where assets have to be sold to fund something. And so that gives us as institutions this advantage to extract an illiquidity premium. And if you think about, because you're in the middle of academia right now, modern portfolio theory and optimizer, if you put this scenario in, it's going to tell you to max out on private equity, right? And most allocators are probably, and maybe rightly so, hesitant to do that. So they put their own constraints, even though the academic literature and the optimizer tells you to do it. So what Bill Dietrich's, I think, Hall of Fame moment was to say, all right, well, I'm going to try that. And we'll see what happens. And we joke. So the Dietrich Foundation is 90% illiquid. So we almost entirely do lower middle market buyout and early stage venture capital. Bill put that in his documents when he was alive. He told his first set of trustees that's what he wanted. But we joke that we're going to be a Harvard business case study one way or the other. We're still waiting to find out. But it's worked so far. But if you talk to any allocator that's at an endowment, a foundation, or family office, you're going to hear consistently an overweight to private equity.
I'm sure for the first year MBAs in the room, you mentioning the optimization sent a shiver down their spine because we had our midterm yesterday. So I want to jump real quick to Amanda. You've mentioned it a couple of times, which is sort of this ESG aspect. You talked about how there are, it's sort of going out of style, but it's still something that's being talked about. And I think there's a lot of people who would almost think that, ESG and investing for public good are one and the same. So can you guys talk a little bit about how you view ESG in the context of your work? And then you mentioned it from, a risk management perspective. I'm curious if you guys take a similar or a different view on that.
Yeah. Go the opposite. Yeah, so we'll work our way down towards. Oh, here you go.
Oh, geez. Okay.
We'll fill in.
Yeah. Okay. This in our underwriting, 100% we do. We have that in our investment memos. We don't have a negative screen, but we also don't have, I guess, what you call a positive screen. We don't have a negative screen is saying, hey, you can't be in coal, you can't be in mining, very simple stuff like that. And so we don't have a negative screen like that at all, but we do have a ESG kind of criteria in mind, which is along the lines of, integrity of our underlying investment managers and portfolio companies. And so with that, it is baked into our underwriting. And I think it's important because to not get too detailed, because there's not a lot of good tools and scores out there. You could go to one provider that tells you this, and another provider will give you a drastically different result. So we kind of take every score with a grain of salt and try to understand kind of the higher level, big picture thing. Let's say we're invested with a mining company, but they provide lithium or, raw materials to the EV transition. So is that ESG bad or is that ESG good? So it's kind of hard to pinpoint. And so we do consider it, but it's a fairly complicated topic in terms of how I think about it.
We think about ESG from a business perspective, and we don't have negative filters where we're just blanket not going to do something. But from a business perspective, we want good underlying portfolio companies that there's a very eager buyer to own that asset and is willing to pay a premium. And a lot of times, many of the tenets of ESG are just good business, right? Like having a working board on the governance side, not creating all sorts of environmental lawsuits later on that a buyer is going to have to diligence through. And of course, having an engaged, diverse workforce that wants to come to give their best each day at their office. These are all, in our mind, good business. And so when we think about ESG, it's not necessarily a box that we have to check from a investment memo perspective, but again, is this manager through maybe a lens of ESG, whatever you want to call it, going to produce good assets that a buyer is going to want to pay a premium for? And many times that's, such a simple screen that you're going to avoid the mining disaster. You're going to avoid the child labor, disaster. And again, and Amanda had also said reputational risk. That's, usually in the back of our mind too. I also want to sleep at night, right? So let's say we're making a lot of money through casinos.
Yeah, maybe a couple more things about how I manage it in my career and how we tend to as a team. So there's a couple ways you can manage. And so on the whole ESG topic, I think ESG as a notion and a term became a total morass rapidly, maybe 5 years ago. I think because it was just that it tried to put way too many things in the same basket. First of all, governance, environmental issues, and social issues are very different topics that require very different quantification. First of all, some governance often isn't as quantifiable. It's more of a qualitative issue. So anyway, that became a bit of a morass because it wasn't well described. It wasn't systematized at all. There were tons of different issues around it, just how the whole industry approached it. I think it became overly bureaucratic rapidly and just stopped achieving what I think were some of the originally intended goals. And the originally intended goals, I think, were various and many. But what we try to think about is two different things at the investment. Do we make the investment or not? And then do we make the reinvestment, like for private equity funds? And do we stay invested with hedge funds? And then along the way, you have the ability to say something. If you see something, you can say something. And that doesn't mean that you're going to be one investor of many. So you don't get the final say and you're not in control in our industry almost all the time. But if you say something, it sort of plants the seed. And if others maybe start to say something, then maybe some things get done, some things get a little bit better. The big investment pools have the most influence and say something a lot more than it might, but I still do occasionally, especially entirely where I can couch it in a business rationale, I will speak up and say something about, I don't think that you guys should be doing this, and here's the business reason why. And I think we get listened to maybe like a third of the time.
Another time to speak up.
That's right.
So Lee and Chris, you both talked about constraints and filters that you guys have as it relates to the ESG context. So just because of the unique, really long-term nature of what you guys do, can you talk a little bit more about some of the constraints that you do have in making these investments and running these businesses?
Okay. Well, I would say just, we try to think about a couple of things. One is, where do we see the best return opportunities? And then we also try to be mindful of our circle of competence, as I think we used to describe, where we have a sense of what we're a little bit better at than maybe the average, and where we don't have the same expertise or institutional experience, and we can't succeed as well. So historically, we generally avoid natural resources, because if anyone on our team could predict the price of oil in 10 years, they wouldn't work at the Dietrich Foundation. So, natural resources historically for us have not performed as well as the other things that we think are more in our circle of competence. We don't do real estate. Bill Dietrich used to say, and don't mean to offend anyone here, but he didn't want to invest in something that dentists could do on the weekends. And so we don't do real estate. And we also generally avoid hedge funds because hedge funds, you're generally, again, I have to say this because so many partnerships have different fine print, but you're generally not rewarded or compensated for the risk of other investors in the fund. So a lot of hedge funds, you can pull your money out during certain periods. And so if you get cold feet in a bad market cycle and you pull your money out and you want cash, the manager to help you redeem has to sell assets within the portfolio. And generally during that time period, he or she is going to have to sell the highest quality assets in the portfolio to generate cash for the investor who wants out. And then what I like call surviving LPs who stay have a less than optimal portfolio, right? But you as an LP have no control on that. And you're just not compensated for it.
Creates a rebalancing risk for the limited partners once that high quality asset is
Right,
sold off.
exactly.
They just have what else to have to sell off and repurchase to get it back to that, and that might take time.
All of that, and that impacts the returns, and you can't diligence the other LPs. So within hedge funds generally, so we don't do hedge funds, real estate, and natural resources. We tend to say our circle competence, where historically we have done better, and maybe we have a little more pattern recognition, is then early stage venture capital, so seed and Series A investing on the VC side, and then lower middle market leverage buyouts. Again, these are usually funds that are below $500 million at the private equity fund, and they're buying businesses that might be doing $5 to $25 million of EBITDA, where the private equity fund is the first institutional investor in that operating business. So that's just what's worked for us historically. We've got 20 years of data showing that seems to be somewhere where we can succeed. And so trying to focus on our strengths versus, from a resources perspective within our team, try to get smart on real estate, smart on natural resources, and maybe a evolved view on hedge funds just doesn't seem to be worth it.
Mhm.
And I guess constraints on my side, it's very much it's more of a capital allocation and budget kind of issue. Given that we are an endowment and we have a draw, a big part of it is kind of thinking about protecting the principal. And so we have guardrails in place, essentially target allocations to different asset classes. And that's a very clear, constraint that we work with. And another one is just sizing your commitment. So within your guardrails, probability wise, on average, the investment managers that either come into our office or we reach out to, they'll probably be in any year median, just with the amount of by pure numbers, every fund we benchmark each of our funds by each vintage year, and it literally divides the entire market into first quartile, second quartile, third quartile, and last quartile, fourth quartile. And so a big part of our constraint is just finding first quartile managers, because by definition they're constrained, either access constrained or aren't looking to raise money. So that's a big part of our decision process as well.
Won't repeat some of the things you guys already said, but maybe the one that I would add is just huge team typically in institutional asset management, and increasingly I don't, but it's right at industry 15 years ago. It is just an exhaustingly big step change in coverage universe across everything from definitely venture, but buyout. Certainly the hedge fund landscape was already massive when I started, and it just gets bigger every year. And so you really have to be very thoughtful and careful in the way that you manage your time.
So we're coming up on the end here, and a final question that I want to ask you guys. We have a lot of people in the room here who are interested in finance, and a lot of people who are considering, a lot of different types of career paths. So in each of your opinions, why is this a place that people should not only look at as a place to make a career, but, the reasons why it might be better than what most people think?
I will say that from just as a Dietrich Foundation recruiting perspective, when we have hired in the past, we have always run into a perception challenge that people are like, well, I just got this expensive degree. Why would I want to go work for a nonprofit? I've got these offers from Goldman, McKinsey, whatever it might be that Jackie hooks you up with. And so there's just not a lot of awareness of endowment and foundation investing as a career path. And it's evolved a little bit, it feels like to me, over the last 10 or so years, where I didn't know anyone that started in this, maybe straight out of undergraduate and made a career of that. There are some places like Yale and Notre Dame where they have storied programs where the best and the brightest and undergraduates take this class that the CIO teaches, and the CIO handpicks one or two people to join the endowment, and then they stay there for 25 years and make a very healthy living. But that's the exception. Most people I know in seats like us had different careers within industry, meaning they were at an investment bank, maybe they were at a private equity fund, maybe they were consultants. But that's given them a wide set of experiences that allow them to look at so many different investment opportunities, right? Because you have to be open-minded in this job and not just say, well, the only way to make your 6% is to lock it in with private credit, and that's good enough. Well, there's this whole other world out there of things that like we just get to see some of the craziest ways to make money. Like we have a fund, it's kind of a bust, but that was more on the execution side, but it was investing in the future earnings of minor league baseball players if they made it to major league, right? Like that I had no idea that existed. And someone came and pitched that. We got to hear about it and listen to this very passionate general partner that was going to go do that. You guys could say countless examples of stuff like that I think having an open mind from a series of experiences, but MBA being a great punctuation point to say, all right, I did my 4 or 5 years in post undergraduate working in businesses. I went and got a MBA, and now this is the moment for me to kind of pivot into something more specific. So I probably rambled a little bit here, but the main point I want you to take away is that there are other opportunities outside of kind of what you think are the traditional spots where you have a big GE or a Goldman or whoever that's at your career fair pitching kind of corporate finance jobs, that there are little small corners of the industry that are different, they're rewarding. I hope you've heard us say that. So you're in it.
And just on my end, outside of the mission, I didn't take this job because of the mission. I'm not a very altruistic person. I liked, post MBA, I interned at Amazon, and that wasn't for me, and kind of realized that, ETF investing is, it's the best kept secret in finance. I interviewed with IB Equity Research my first year. I had a kid and I was like, I can't do that. So, the work that we do is so interesting and so broad. If you're a very sharp tool and you just want to stay in, let's take my job at PNC, for example. I worked in asset-backed securitizations. So what that meant was we saved interest costs for Fortune 500 Fortune 500 companies by securitizing their receivables. Now, that's not even an asset. That's a line item within a line item within an asset class. That is so pigeonholed, and no offense to anyone that wants to work in ABF, but that just wasn't for me. And in our jobs, in my daily job right now, I could, if I wanted to drill in on, hedge funds that specializes in tax receivable agreements, like you could go do that. There's such a broad array of investment strategies, and the people that you meet are just genuinely so passionate and smart that it literally blows my mind. Like some of these conversations, I'll walk away and be like, I understood 10% of what that person was talking about. Can you explain it to me? And then I'll go Google and Investopedia and be like, okay, here's what a tax receivable agreement is. Like if you have a broad array of interests and you want to kind of generally work in investing, I think this is the best job on, the planet in terms of trying to figure out what you want to do, or if you just like meeting really smart people and investing. So that's just my take.
Can I ask, how many of you know what the LP or institutional investor allocator industry is? How many of you, like before today, did you know what it was? Yeah, okay. I think that's so first on the awareness question, I think that's a much higher percentage, even among an MBA program than we would have found in a room like this 10 years ago, which is interesting. So what you guys covered all the main recruiting points that we usually run into as well, which is, prestige. You're going to get more, generally candidates are going to feel more prestige if you're involved with a hedge equity. Because those are things that just had more awareness. So if you want to kind of like brag to your classmates about what you do, it's good that everybody's going to know what you're doing if you're going to one of those places, or a big tech firm in the last year as well, versus our industry wasn't as well known. I think that's changed now. Work-life balance used to be, and I think you touched on it, Chris, when you said I couldn't do investment banking anymore. I too started in investment banking and worked my 100-hour weeks and had the resultant health problems for a little while. And this was a really great work-life balance industry historically. I think it has become a lot more competitive. It's become a much bigger industry. Everybody's got an endowment now. Everybody's doing private equity. Everybody's getting into co-investments. It's big and it's discovered. So I think the work-life balance is steadily getting a bit worse. But I would echo everything you guys said about the breadth of what you see is very interesting and intellectually stimulating. The quality of people you interact with is the world's best. I mean, it takes everything to be a good enough private equity or hedge fund manager to even get a meeting, much less get capital. So you meet the world's best all the time, every day. And that's pretty phenomenal as well. You can't go deep though, is the other thing. Back to my time management point. If you like going deep on a particular company or whatever it is, this industry is not for you and you will not survive. So that's one thing I'd say. Another I would say is you probably shouldn't start in our industry. Because again, small team, limited resources. So we don't have time to train you. We need people who have already been trained for a couple of years. And just generally, I would say it's a great place to start on Wall Street with an investment bank. Probably with a big tech firm these days as well. I didn't go that path, but I think that's probably also a great place to start. Or with a big management consultant as well. You really can't go wrong with starting in those places. They're big enough with massive enough resources. They're going to put probably $100,000 worth of resources into training you up. Today, I think back when I went through, it was probably like 40 or 50,000. It's probably that today. And so you get that and you get just a diaspora of contacts that will follow you through your career and be very valuable. And you can always stay at a place like that and make a lot of money if you can handle the churn.
Well, I want to thank you guys for your time today. This was absolutely fantastic. Can we have a round of applause for our great panelists? And I think that'll do it. Thank you, guys. Yeah, actually, yeah. Is there anybody who wants to ask a question from the audience? Mac.
Second year, name's Mac. Thanks for coming out. So the topic of this was around, investing in public good to an extent, or altruistic, as Chris said. Is there ever a world, or is there a direction in which these large endowments begin to partner up and invest in larger capital and super capital intensive projects, infrastructure, energy transition, aspects of our Say that again?
The next $7 trillion chip foundry.
Well, it doesn't even, it could be that, but it also could be.
That is one of the world's biggest line items.
Yeah, obviously, there is a lot of infrastructure that has gone unaddressed from a capital improvement perspective over the last 40 years. And regardless if you believe in the transition to renewable energies or other technologies that are adjacent to that, it seems like perhaps an interesting angle on how to provide capital for those, hyper capital intensive projects that typically are done for natural monopolies. I don't know if you guys have ever like spitballed ideas on, hey, let's, partner up the Dietrich Foundation with the Carnegie Institute and see if we can solve provide a solution in the capital stack for that.
Well, from a philanthropic side, at the Dietrich Foundation specifically, like we can't change Bill Dietrich's mission. So Carnegie Mellon University will always get 53.5% of our annual distribution. So that's locked in. But from an investing standpoint, it would have to meet our return hurdle, right? So it would have to be interesting economically so that we could then funnel that money to CMU, Pitt, and others. But where I think you might see a little bit of what you're describing is wealthy donors creating foundations specifically for purposes that they think are important. So think of, the Bill and Melinda Gates Foundation that maybe from an investment standpoint, but also from a grant making can funnel money into capital intensive endeavors. And there might be some return portion of it, but it might also just be their philanthropy.
It seems like it's a same time.
So generally what you're describing sounds to me like it would be in the category of what I would call impact investing, which falls between the grant giving side of most endowments and foundations, which are by law required to never invest in any money. Right? It can't actually make money. It has to be run as a nonprofit. And then the investment side, and by policy for most of us, we can only focus on the bottom line as fiduciaries. And so unfortunately, there's an in-between that rarely gets created for the traditional endowment foundation world in the United States. It does happen, but it has to be, like, for example, I want to say Carnegie Mellon has a carved out pool of the endowment that goes to something that looks like impact investing. And it's specifically defined policy around that pool of capital that it's got maybe some return orientation, but it's got some other like invest in the community type goals too. And that's kind of how you can do it. I don't want to speak for CMU, but I've seen programs like that, but they're usually kind of small and they're very difficult to build support around. The broader endowment or foundation typically can't do that kind of thing. Like, let's say the chip foundry proposes to build in Pittsburgh, going to create, trillions of economic activity and jobs, et cetera. That would be an incredible thing for the Hillman Family Foundation to grant to, except that they can't do it legally if it might make money.
So this, you kind of touched on it a little bit, but your process for manager selection. So if a lot of your returns are coming from sort of those guardrails, Chris, you were talking about for asset allocation. If you have a manager come into your office, who decides who gets the capital and why?
Just a point of clarification, Charlie is the president of the Alpha Club for asset management. He also participant in UNC's Alpha competition this year.
So do you mean from a governance standpoint or from a filtering standpoint, like top of the funnel stuff?
I guess, yeah, top all the way to the bottom. I mean, in terms of who actually gets an allocation.
This is you're asking an hour question. So I mean, generally sourcing comes in a few different ways, which would be us proactively reaching out to managers that we've heard of, or from managers that are referred to us by peer organizations that say you should talk to so and so, or the cold call of a manager sending us an email saying, hey, we would love to pitch you. So that's the top of the funnel. The early, I'd say, kind of criteria would be, is it something that we're interested in, meaning lower middle market buyout, private equity, again, broadly. And then you start to get into the more granular things of track record, right? Are these people, are they the first person to say that here's a unique edge that we might have within the markets, whatever that might be? Or are they the 20th person this week that said they're the only person that knows how to do this? And that comes back to us taking a lot of meetings so that you get a sense of what's average and what's exceptional and what's pretty poor. And then from a governance perspective, everyone is unique. At the Dietrich Foundation, we don't have an investment committee. Our CIO has full investment discretion. So as a staff, we just have to pitch it to him. If he buys in, then we can sign the docs and commit. But every organization is going to have a different governance perspective or process on making those final decisions. And maybe each of you can highlight that real quick.
Yeah, just say quickly, so at Pitt, it's very similar to Dietrich. The IO has discretion up to a certain percentage of the endowment on the private side. At CMU, every new liquid commitment we would make, we would have to bring it to the investment committee, which is made up of, I want to say five people.
We're speaking to our investment committee approval structure, yeah. We're a 6-person investment committee on the team, and if 2 of us say no, it doesn't happen. We meet when we have to, but we generally like to get to know people over a period of time. And then our CIO decides sizing.
Maybe just briefly, I'm happy to chat with you afterwards. But thanks for coming. And if you want any of our contact information, I think Nick should be able to get it for you.
Yep.
If anything we said, sparked your interest, or you want to know more. But we think that this is important to be in front of students and raising your awareness of what we think is a rewarding career path.
You beat me to it on the contact information. I was going to mention that, but all right. Thank you guys. Greatly appreciate it. Thank you for letting us.